Good morning, everyone. Welcome. Thank you for joining us for today's webinar on the construction industry in the 9th District. I'll turn it over to Ron Wirtz in just a moment. My name is Carmiana Matson. I'm with the Minneapolis Fed. Thank you for being here with us this morning. Today's webinar will be recorded, and we will be emailing a link to it at the end of this session, as well as a link to Ron's slides for those of you who would like them. During the presentation, if you have questions for Ron, he'll leave about 5 minutes at the end for Q&A. If you can find the Q&A button located at the bottom of your Zoom screen, you'll be able to type your questions into the Q&A box, and I will present those for Ron. If we have a large number of questions, we may continue just a few minutes past 9:30. If at any point you need to leave us, you can close the webinar box, and you should receive a pop-up survey that you can complete to give us feedback on our event. With that, I'm going to turn it over to Ron.
Thanks, Carmi, and good morning, everyone. I really appreciate you taking the time to join us this morning to talk about a recent survey that we've conducted. And I'd really like to just thank all the partners that might be on the call and all of those businesses that may have taken the survey. The information that we're getting is really valuable to the bank. We're happy to share it publicly, not only with our partners and with businesses that have taken the survey, but also the general public, as we're really trying to get more information about the current economy out to people that need it. Before I get into the survey results themselves, one second as I minimize the box here to give me a little more screen. I need to give you the disclaimer that the views expressed here are my own and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So the reason we're doing this survey, the reason we're doing this event is that there's this COVID data challenge that we have right now. The speed of the pandemic has really created a need for more real-time information. Most of the data, as you might guess, the Federal Reserve Bank of Minneapolis and the Federal Reserve System gathers an awful lot of data, but a lot of that macro data is time lagged. Without going into too much detail, gross domestic product is a major measure that we look at that's several months time lagged. Even unemployment figures are time lagged by several weeks. So we're really looking for more ways of finding new information. And so we're doing a lot more outreach. And so the department I work in, we've done 11 surveys of businesses in the Federal Reserve's 9th District since mid-March. We've gotten feedback from almost 9,000 businesses, and they've really opened their stories to us in terms of providing us with a lot of comments that really help us get a granular feel for how firms are doing in the current economy. We recently did a general business survey, got 1,100 responses. Shortly after that, we did a construction survey, and that's the survey that I'll be talking about today, with more than 600 responses. And then we also have a professional services survey that's currently in the field. I'll talk a little bit more about that at the very end. So I also want to let everyone know that the webinar today is part of this new series that we're doing from the Minneapolis Fed. This is really an extension of an annual conference that we do in January that's really intended to help connect businesses and community leaders with the research that's coming from the Minneapolis Fed about the regional economy. We're doing more surveys and gathering a lot more real-time data. And these webinars are really meant to help connect us more frequently with businesses and community leaders about those real-time conditions. As I'll describe in a little bit, many of these surveys are using partners to help get surveys into the hands of businesses. And these webinars are also a value added for our partners and for those taking surveys to get information directly to them. So a quick shout out to all the partners that participate in this survey. There's too many to list individually. There are about 35 partnering construction organizations across the 9th District. And really, they're the ones that are delivering the bank's survey to their construction members. This is the 4th survey that we've done on construction since the start of the pandemic, but this is the first one that's been district-wide. The other 3 were Minnesota only. We had such good luck with that, and we really had that need for a broader perspective that we've approached organizations in the Dakotas and Montana, the Upper Peninsula of Michigan. That's also included some Wisconsin firms. And for anyone listening in those states that are new partners, thank you very much for your help. And to date, with those 4 surveys, we've gotten about 2,500 responses. And we believe these are really crucial insights for the bank because we really consider the construction industry kind of a bellwether sector to really tell us where things are headed right now. So a little bit about the construction sector. was conducted at the end of July, and we got 636 responses. We got responses from all 9th District states, though our response numbers are a little bit smaller in the Dakotas, Montana, the UP of Michigan, and northern Wisconsin. We have very strong responses in Minnesota. Each of the 4 main sectors are represented: residential, commercial, industrial, and infrastructure or heavy. And we also ask firms to identify their firm type. So we have responses from architecture, design, engineering, multiple different contractor categories, and then material supply and some others. So we really have a really nice cross section of feedback from the construction industry. Real briefly, in terms of what I'm going to discuss, I don't think I'm telling a lot of people anything new, that there are lots of challenges in the sector right now, and I'll be covering a lot of that, but there is actually a lot of similarity across states and sectors and firms. The sector itself appears to be, again, in comparison, in fairly good financial health, but there are concerns about the future level of work. I want to just let everyone know that these results are more of a snapshot. Because we used partners to get surveys out to businesses, this is not a scientifically sampled survey, so we would ask that any use of this data is that you interpret it with care. I am going to be covering a lot of data using a number of charts. Pace is going to be pretty quick. As Carmi mentioned, we'll be sending the PowerPoint and video we'll be posting that to our website and sharing with registered guests. So I would ask that you try to keep with me on the high level themes, and you can follow up with a closer look later on. So my first focus, we're going to talk about cancellations and delays. So I'm going to spend a little bit of time just telling you about kind of the color scheme and how to read some of these charts. So we asked firms to compare their May levels of cancellations and delays with right now in July. Okay, and we asked them to identify public and private projects for both delays and cancellations. And what you're looking at in terms of the chart is the red means things are getting worse, and the deeper the red, the worse they are in terms of the level of delays or cancellations. And what you see here is that in the May survey, many firms were telling us that they were starting to see delays and cancellations. And what our July survey is suggesting is that this trend is really continuing. So we're seeing roughly about 50% of projects seeing some delays. We're seeing a slightly lower level of cancellations, but of course cancellations being a little bit more serious because those are projects not going forward at all. And we are seeing a slightly higher level of delays and cancellations among private projects versus public projects. So what I'm going to tell you now is I'm going to focus now on cancellations in July and what firms are telling us from a couple of different slices. I'm going to look at geography, I'm going to look at sectors, and I'm going to look at firms. And we're always going to be talking about July cancellation levels compared with May. And what you see in terms of geography is that for the most part, we're seeing very similar levels of cancellations across the 9th District. I think in general, you're seeing a slightly higher rate probably in North Dakota, in part because of the downturn in energy exploration and production. It's a very capital intensive industry, and I think that's possibly one of the reasons why you're seeing a slightly higher rate in North Dakota versus others. But again, in general, where they're lining up very similarly across the 9th District. We looked at the same question by sector in terms of the 4 major: infrastructure, commercial or non-residential, residential, and industrial. And again, what you're seeing is while there is some variation, for the most part, all of the sectors are seeing a fair amount of cancellation levels at this time. We're seeing a slight advantage in residential building. That theme will come up a little bit later as well. And infrastructure and heavy is also seeing a slightly higher rate overall, and a little bit higher share that is seeing cancellations rise significantly. If we looked at it by firm type, so we asked again for firms to identify different what type of firm they were. Again, not to sound too redundant, but for the most part, we're seeing more similar results across firms than different. Now, there is some variation. I think down here, you have architecture and design, seeing a lower level overall compared with, some of the contractor levels. But for the most part, we're seeing similarity across lots of different firm types. I guess as probably you would expect in terms of if there's broad geographic and broad sectoral, you would kind of expect most firms to be impacted. So the second focus, so we've recently just talked, so we talked first about what's happened recently in July compared to May. We also asked firms to essentially tell us about their pipeline. What are you seeing in terms of requests for proposals, bids that they're able to put out for future work? And what we see here is that, again, I'm going to back up to the larger picture. So we're going to talk about July RFP activity compared to May levels. And what you're seeing here is that in the May survey, we were being told that RFP activity was already dropping. The July survey says that trend appears to be continuing. So you have private projects here, roughly 50% of firms are seeing some pullback in the level of requests for proposals that they're seeing out there. Very similar level in terms of public projects as well. And then as you would probably expect, with the pipeline of work shrinking, more firms are bidding on fewer projects. So what firms told us is that they're seeing an increased number, this portion right here, they're seeing an increased number of bidders on the projects that are still out there. Again, I'm going to give you that state and sector and firm look at how things are, and it's largely the same story. So RFP levels by state, again, you see some change among the geographies, but not a tremendous amount. You are seeing Minneapolis-St. Paul on the bottom here, seeing slightly larger impacts in terms of their RFPs compared to some of the other states in the western area. What I would say, if there's any good signs, is that for the most part, we're seeing somewhat lower levels of RFPs. We're not seeing really strong levels of significant drops. But again, decline is decline, and I think that's not great news. In terms of the sectors, again, fairly significant levels and pretty similar, especially among infrastructure and heavy non-residential or commercial and industrial. I would say if there is any particular area that is seeing some different results right now, it's in residential building. So I would say two things. Not only do we have a lower level overall of RFP, or fewer people saying that RFPs are dropping, we're seeing a larger number that actually are seeing some growth in that area. And we've also heard about that anecdotally, that residential markets are still relatively strong, especially in certain markets. And so that's, I think, one of the good news coming out of the survey right now. So let me go back 1 second. One thing I didn't point out, so this is for private projects. One thing I also wanted to point out is that I also wanted to show public projects. For the most part, we're seeing a little bit of the same. I would say what you see here is that in many of the sectors, there's less of a presence. So in residential building, we saw roughly the same, a lot of the same results, with the exception of in certain areas, you're seeing many more just aren't involved in that particular sector. But all areas are seeing some pullback as well as in public sector bidding. And then again, by firm type, what you're seeing here is similar to what you saw in terms of recent activity. Architecture here, the one thing that I noticed here is that while it has overall it has a more positive spin overall compared to the other sectors or the other firm types. They are seeing a little bit higher pullback in terms of the number that see a significant pullback in RFP. Not dramatic compared to the others, but it is notable. So my third focus, I just want to talk about some of the other results. We asked about we asked about a number of other kind of firm metrics that I wanted to share with folks. First one was, excuse me, first one is on workforce. So we asked about current and near-term expected staffing levels. And so we asked about July staffing compared to May. And what you see in this one is that there's a slightly higher share of firms that are cutting workers than those that are adding. But how this compares to the general business community is that we're seeing more construction firms still looking to add workers. So that's the good news here too as well. In terms of future, the expected staffing levels by the end of September, what you're seeing is that there's a little bit of a acceleration in terms of those firms that are expecting to see slightly smaller staffing firms come end of September. It's hard to know exactly what that's from, but the fact that firms are saying they're seeing lower RFP levels is likely compounding what's happening in terms of workforce. What's interesting about that last slide is that there are actually firms that are looking for workers. They're having a lot of difficulty actually finding workers. You know, given that some firms are cutting workers, we have a high unemployment rate overall. This is a bit of a surprise, at least to those that maybe aren't familiar with the sector. Those on the call probably the obvious exception. This is something that you're probably experiencing on a daily basis for those that are in the construction sector, but there is very tight labor, a lot of difficulty for a lot of firms that are looking for labor. So for the most part, you're seeing roughly more than 50% seeing some difficulty and some significant difficulty in trying to find workers. In terms of wages, I would say this is the other good news that comes out of the survey, but should qualify that it's good for workers. Firms, again, in this environment where work might be getting cut back, this is obviously another competitive struggle for them to try to find and keep workers. They're finding that they're continuing to have to raise wages in order to attract and keep workers. So we are still seeing fairly strong wage growth. We're seeing more firms raise wages than cut them, and they expect to continue doing that going forward. Now, again, from a general economy standpoint, the survey that we did in July with general businesses, we found that the opposite is true for businesses overall. Many more are cutting wages than are raising them. So the construction sector is seeing the other side of that. We also asked firms about price inflation, particularly for non-labor inputs and materials. And what you're seeing here is generally either similar or faster price inflation of materials and inputs than what you saw pre-pandemic. So the very far left bar are those that responded that price inflation was slower than pre-pandemic levels, the same as pre-pandemic levels, and price inflation faster than pre-COVID levels. And this is since the onset, and this is what's expected over 2020. And you're seeing very similar results from each time period, but basically you're seeing roughly 40% that are seeing higher price inflation for inputs than they saw pre-pandemic. And we think most of this has to do with material shortages and other supply chain issues. So when we started in the pandemic, what we heard from a lot of businesses is that there were delays, and there were delays for reasons that had a lot to do with COVID, but not necessarily from demand. And what we're seeing now is that there's a lot of supply chain breaks, not necessarily because of infections themselves, but because of the things that can happen to supply chains as a result of everything that's going on now. Whether it is a glitch at the manufacturing plant or in the distribution net or even on site, there are lots of things that can go wrong, and we're seeing supply shortages as a result of that. And so it's not necessarily a supply shortage in terms of net demand, but it's getting the necessary materials to the necessary place at the necessary time. And all of those factors kind of compound. We're seeing a lot of price inflation, particularly in things like structural lumber. Oh, excuse my my large chart here. It must have resized on me. Apologies for that. Then the last thing we did is we asked about solvency. And what we see in this is that the good news here is the very dark bars. We're looking at solvency of 1 to 3 months or less, that kind of near-term time frame, especially from a policy standpoint in terms of thinking, how do we get through the next short-term period in terms of trying to get firms to the other side of this. We're looking at 1 to 3 months. And what you see in the construction sector is that only a very small number see themselves not being able to get through the next 3 months, roughly about 5%. I would call that very, very good news, especially on a comparative basis. I mentioned it earlier that the the financial solvency levels of the construction sector seem to be very good compared to the rest of the economy. We asked this question about in the general business survey. Roughly about 16% of all firms can't make that 3-month window. Here it's about 5%. So we are seeing some steady improvements, not only in general businesses, but also in the construction sector as well. The one thing I should point out though is, as we do these surveys, we know that COVID has had a tremendous impact on firms. So we know some are going out of business. We don't know how much this improvement might be the result of previous respondents dropping out of the survey itself. So I at least have to acknowledge that. We don't think it's a major part of why solvency is improving, but we think it might be part of it. So moving forward, just a few slides left before I get to some questions, is that we're going to continue doing survey work, and I want to let everyone know that we're going to do another construction survey in late October. So we're on a quarterly basis now, and we're hoping that we can really continue to see the great response that we've gotten so far. We are also doing a lot more, we're gathering a lot more and better real-time measures of economic activity, and I want to talk a little bit about that. So for those that are not familiar, we've put together a new COVID dashboard for the 9th District economy. So if you just Google COVID-19 dashboard Minneapolis Fed, you'll come to this website. And I just want to point out a couple of things. We have a lot of consumer measures, a lot of real-time consumer measures that give you a lot of functionality to choose. You can turn off any of these states in any of these charts, and also look at different categories that are listed down here on the bottom in order to just take a look at how things are performing in the 9th District. We not only have cell phone data and traffic mobility issues or data, we also have things like TSA screenings and Minnesota Department of Transportation traffic patterns. And so there's just a lot there that I would really encourage anyone interested in more information to take a look at our dashboard. I also wanted to point out that we're going to be continuing this series of webinars. We have a professional services survey that's in the field right now, and there'll be a webinar on September 23rd, same time, 9 o'clock. And this is a survey that we do in partnership with DEED, and it's also district-wide, and that webinar will be held by Joe Mann, my peer in regional outreach. And right now, I believe Carmi has the link for that particular webinar in the Q&A box if you would like to register for that. That's the end of my formal presentation. I just want to take just a moment to thank everyone for attending. And to those businesses that are out there, I really want to wish you luck. I know this time in this COVID environment is really, really tough. It's tough to run a business anyways. In this COVID environment, it's tough times 10. I really just want to wish you luck. For those that have participated in the survey, I want to say thanks for doing so. It really provides the Minneapolis Fed with a tremendous amount of information that is critical in helping us set monetary policy. And I'm going to turn to the Q&A now. And if you have questions, you use the Q&A function to submit those questions. And I'm happy to take any right now, Carmi.
So Ron, while we're waiting for those to roll in, you did a lot of comparison between May and July, but you have done 4 surveys on the construction sector, right, since the outset of the pandemic. So can you tell us what's the overall trend you've been seeing?
Well, I would say the overall trend is that we're seeing significant impact, and that it's generally not going away yet. I would say what we are hearing, what we've seen probably since the very start is we started to hear more whispers about concern about future pipelines. And I would say as we've gone forward with this, I've seen that probably solidify and maybe worsen a little in terms of maybe some fears being realized with future projects not being quite as numerous as they had hoped. Now we came into 2020, I think, on a real confidence boost. We were hearing of very full pipelines, and really lots and lots of work in the construction sector. I think what we now know is that there have been cancellations. Businesses have still managed to stay busy because those pipelines were full, so they were pulling some work forward. So that was the good news. I think the construction sector has been still fairly busy over the summer. I think there's just more concern about what's happening in the fall and in 2021.
Thank you. We are going to turn now to participant questions that are rolling into the Q&A. And I would like to just have a gentle reminder that folks, as you're leaving, if you could wait for the survey to pop up on your screen and give us some feedback for our future webinars, that would be fantastic. We may go a minute or two past 9:30 depending on the number of questions that are rolling in. So let's start with this one. With respect to the shortage of workers, Ron, any idea how much of that is due to unemployment benefits, or are there other contributing factors?
Yeah, great question. It's that's an issue that we hear a lot about. What I would say is I don't think we have a great answer about how the enhanced unemployment benefit has affected not only construction, but other sectors as well. If you were a restaurant, I think you did have some difficulty also drawing your workers back if they were receiving that enhanced benefit. We're hearing about it in the construction sector. I think we'll find out more in the coming weeks, depending on on what exactly gets approved. Excuse me, in terms of future unemployment benefits. So we're going to learn more about what happened in the past by kind of watching what happens in the coming weeks, I think. I don't think there's any question there's been some influence on it. I think we're maybe seeing less in the construction sector, in part because it's a much better paying field to begin with. But that is not to say that it hasn't had some influence. We don't know exactly how much.
There's a question specifically about renovation and adaptive reuse of buildings that have current tenants. Do you have any data on whether there have been delays or cancellations in that sector versus new construction?
Yeah, unfortunately, no. That's actually a really good point. That might be something that I approach partners with to see if they would like to find out. I think because we didn't ask about whether projects were new or renovations, things of that, I would be inclined to think that whatever you're seeing for new projects are probably the same as some renovations. We have heard about a lot of renovations in the residential space. So in terms of whether or not that remodeling and renovation is also entering the commercial space, we know some of that is happening. Whether or not we're seeing a similar level of cancellations, unfortunately, we don't have any data to suggest one way or the other.
And a little bit of a shift here, Ron, to a monetary policy question.
Mm-hmm.
It was noted by an attendee that the Chair Powell came out today and said that we are moving to an average inflation target of 2% as a new
Mm-hmm.
policy, and wondering if you can comment on what that means and what we can expect to see over the next 6 to 12 months.
Well, I think I didn't see, I've heard that speech was coming, so I am familiar. And basically, I think what the Federal Reserve is doing, and here I have to kind of couch some of my comments in that our bank president is a much better spokesperson for what's going on there. But for the most part, what we're doing is that rather than having a 2% ceiling, I think the Federal Reserve is going to be more patient about inflation that possibly exceeds 2% in order to spark some demand, but always trying to keep it around that 2%. So rather than it be a ceiling, it's a target. So if just like we try to get, if it's too low, say it's 1%, we're going to try to do things that maybe increase that a little bit to our target. Similarly, if it goes over 3%, I don't think you'll see a very quick reaction necessarily from a monetary policy standpoint. Again, target, not ceiling.
Thank you. Looks like we've a couple more last questions piling in here. What do you hear from office building owners about future demand, given that so many folks are working from home?
Right. This is anecdotally. We know that right now foot traffic in downtown Minneapolis, for example, is a fraction of what it normally is. I don't think there's any question that there's concern among building owners. The useful part is that most most, especially large office buildings, have long leases in them. So I don't think we're seeing a stampede out of buildings because their buildings have contracts involved. But I do think there is some concern about what the future might hold in terms of new leasing. I think what we have been hearing is that there are some lease renegotiations going on. I think for both sides, I think there's advantage to both sides. What we've heard a little bit about is that in terms of any renegotiations, there might be some concessions given to the leasee, but then as some additional years put on the lease itself for some advantage to the building owner. So I don't think there's any question there's some pressure on the office market right now. But what we're hearing is that because of these longer leases in offices, we're not seeing dramatic changes right now, but we expect that to evolve as we go forward.
Any insights on the future of vacant properties in the retail sector?
I would say it's not dissimilar to office. It might be a little bit more. I think the impact is likely to be quicker, and without question, there has been some very significant impacts on the retail sector. What we're finding out is that those retail businesses that have been able to pivot into the new kind of social distancing model and things of that nature are having more luck. Those companies that have been quick to offer curbside service or other things that are essentially assuming this is the environment going forward, we're going to have to adapt or perish. Those are having more success. But without question, going back to my general business survey, we're finding that a lot of retail is struggling right now. We're finding a lot of other firms like accommodation, food, beverage establishments, they're obviously having struggles as well. And the longer that these conditions persist, if there's already stress, that stress is only going to compound. So I think in retail, you'll probably see a little bit quicker evolution of the impact, maybe more so than in other commercial sectors.
And that is a good segue here into this question about, do you see COVID itself changing the construction landscape? You mentioned retail businesses adapting with takeout. What about in the construction industry, air handling, long-term care facilities, schools? What changes are you seeing there?
Well, I can't really speak to that too much. Quite honestly, I'm sure there are a lot of people on this call that could answer this better than I. I don't think there's any question that construction processes, the way firms handle individual projects, it has to change. We've heard even just staffing practices where normally workers went to project sites where there was work. Now we're hearing about more firms keeping workers especially on bigger projects, exclusively. So even if there's a delay in that particular project, they're not going to move them to a different site, in part because of the social distancing and the mixing of different people, and the interest in not exposing workers to other workers, even in the same firm, when they don't know whether or not what they're trying to do is keep infection rates down. Because if you get an infection on a job site, that can be a delay itself. So we're already hearing about changes like that in terms of how firms are really being sensitive to the need to keep infection rates down, even in their own workforce, in order to keep projects going. So I don't think there are many changes, I'm sure, going on in the sector. Unfortunately, I'm not a great resource on that.
Right, we're going to take two more questions. First question, are we seeing an increase in firms going out of business in the construction sector?
I think it's safe to say that we are, if you compare it to pre-pandemic levels. What we don't know is exactly how many are going out of business. There are not good measures for firms going out of business. It's one of the things we're trying to work on, is to actually look at exits. But unfortunately, whereas when you incorporate a business, there's a transaction that you can track. When you go out of business, there's less of a death notice, if you will. So it is harder to know exactly how many firms have gone out. I think just because of the sheer scale and pressure of COVID, I think it's safe to say that you're seeing a higher incidence of firms going out of business now than pre-pandemic, but we don't know exactly how high.
All right, and our last question is about future survey questions. What are your plans for upcoming surveys and whether the questions will change to accommodate
Right.
new COVID issues?
Well, as a matter, I think that's a great question, and for any partners out there, that's one of the things I'm going to be asking you about. I really depend on my partners, my construction association partners. You all have your fingers in the industry, and I'm really going to be looking to my partners to help identify what's the new thing that we need to ask about for the benefit of your organization, the benefit of your members, because what's important to you all and what you see coming down the pipe is really what's going to be what the Minneapolis Fed wants to know. These surveys have been tremendously helpful in helping us really gauge what's going on, and I look to my partners to help, figure out what the next best questions are.
Great. That's all the questions that we have today. Thank you so much for joining us. We will be emailing all of you a link to this recorded webinar as well as to Ron's slides. And we'd appreciate it if you would complete the survey that pops up when you exit this webinar. Thanks so much for joining us.
Thank you very much. Have a great day.